One of the most fixated on pieces of information in any financial report because it all boils it down to one thing. Given my individual ownership share, how much money did I make on that share today? So we want to be able to disclose that, but it's there's a lot more going on in financial reporting than just one number. But earnings per share is clearly and will probably continue to be a very important figure for users of financial statements. So the textbook I think we're still, no, I don't think we're in chapter 19 still. So earnings per share, we're going to talk about kind of your basic earnings per share calculation, and then some other calculations that also have to go along with that. And in the codification, we want to spend our time, right? This is a presentation issue, right? It's not a asset or liability, it's a presentation issue. And we're going to go down to section 260 to look at earnings per share. Now, this is a presentation issue, and most of the information that you're going to be looking to review is both in other presentation matters and disclosure. So in other presentation matters, it goes through and tells you what's required on the face of the income statement and what is required to calculate. And so we're going to go through and think about this. And the first thing we want to look at is basic earnings per share. And the key here is basic earnings per share on income available to common shareholders. So basic earnings per share available to common shareholders. So in your previous class, you learned that there may be different classes of equity. You may have had, and again, depending on how it was described, we're moving away from this notion of common versus preferred, even though the literature still is holding on to common versus preferred. But you may start seeing it articulated as Class A shares, Class B shares, and different classes of shares depending on what their priorities are. And this is something that you should have had in the prior accounting course. So in certain cases, and we'll try to stay with the common versus preferred for this discussion, but I want you to make sure you're aware that the move is away from common versus preferred to varieties of different classes, because I might have different class preferred shares, if you will. And so instead of calling the long name, we can have class C, D, E, F, G of different types of equity. So in the preferred versus the common shareholders are really the owners of the company. They take a lot of risk. They have lower priority in payouts during bankruptcy. There's no guarantee of dividend. Preferred shareholders, well, it's likely you get your money back. There is a percentage of dividend. It's not guaranteed. Could be if it's cumulative preferred. But there could be dividends. Those dividends are stated. And there's a liquidation value. And that liquidation value likely takes precedent over whatever the common shareholders would get. So in the ordering of liquidation, in the winding down of a company, they would be ahead of the common shareholders. So we're really looking at income available to common shareholders. So if you also have preferred stock, so if the organization has preferred stock, and they pay dividends, so this is a Both conditions have to exist. And they paid dividends. Or, again, think about the logic, preferred stock and pay dividends, or if they didn't pay dividends, or it is cumulative preferred. And that, if you recall from your previous course, that means they are obligated. If it's cumulative preferred in the contract, in the preferred stock contract, they're obligated to pay dividends, even though they may not in future years for previous years past non-payment of dividends. So if it's cumulative preferred and I go through 1 year and I don't pay dividends, I go to the second year and I decide to pay dividends, I've got to pay the first year's first, and then I can pay the current year's if there's any money left over. And then if there's any money left over that, then any dividends then go to the common shareholders. And this is just a review from your summer course. So if we're looking for income available to common shareholders when we're trying to figure out basic earnings per share, I need to take my net income and subtract out these preferred dividends. Whether or not I paid them or whether or not they're cumulative, because there is an obligation for me to pay them eventually. And even if I have declared these dividends but still haven't paid them, I have made a declaration. So that's going to be net income that is available to common shareholders to get rid of the preferred dividends. So that is in the numerator of our equation in calculating earnings per share, right? This screams out earnings divided by shares. So this is the earnings in the numerator. We can kind of guess what goes in the denominator. Shares. But what measure of shares? Well, we want to use weighted average shares. And that's weighted average shares outstanding. Weighted average shares outstanding. So you could have had shares that you issued and were outstanding, but you bought them back as part of treasury stock. Well, that would not be factored into this. So it's weighted average shares outstanding. You learned about treasury stock in your previous course. So this is your basic EPS. Now there are going to be things that need to be adjusted from time to time. So if we had contingently issuable shares, so there was some contingency that existed that if the contingency is met, then the shares will be outstanding. You'd have to factor that. You may have to factor that in. But you can go to the literature to see whether or not you do or do not have to factor in contingently issuable shares in this basic earnings per share calculation. Now that's different than conversions or options or warrants, right? So a little bit different. We'll talk a little bit more about what other adjustments might have to be made to this basic earnings per share calculation.